This morning, silver collapsed by $15 in just 30 minutes. It dropped from 121 straight down to 106, a 15% plunge in half an hour. And as I'm recording this right now, silver has already flipped green on the day. Let me repeat that because it matters. After falling $15 in 30 minutes earlier today, silver is now trading positive on the day. Current price? Around 117. This is not how normal markets behave. What we're witnessing in real time is the physical silver market completely overwhelming the paper manipulation structure. The system is fracturing right in front of us. OG, John AG here. January 29th, 2026. Quick note, I'm posting live charts on X as events unfold. Vault movements in real time, technical formations, and structural signals that don't make it onto YouTube. That's where the sharpest analysis is right now. I'm also preparing to roll out some serious tools over there. So if you're not following yet, now's the time. The handle is OG John AG on both platforms. That's your filter. That's how you know it's legit. Fake accounts are everywhere. I see them too. I can't report them all. But OG John AG is verified, protected, and untouchable. New viewers, understand this. I don't sell anything. No signals, no courses, no paid groups, no begging for subscribers. We look at the full picture here. Rational, grounded, no hype. Just independent analysis. Many of you get real value from that, and your comments teach me as well. Drop your thoughts below, or just comment OG John AG, so my team and I know the real community is here and active. Now let's get into why today is truly unprecedented. According to data coming directly out of Shanghai, silver is currently trading at 31,620 yuan per kilo on the Shanghai Futures Exchange. That converts to roughly 141.42 per ounce. Meanwhile, silver on COMEX is trading around 116 to 117. That means the Shanghai silver premium has exploded to $25 per ounce. $25. In the past, a smashdown that knocked silver 15% lower in an hour would trigger cascading stop losses and spark days or even weeks of continued selling. Silver's upside momentum could be completely destroyed by a COMEX paper dump of a few billion synthetic ounces. That was the old playbook. That playbook is finished. Today, physical demand for silver is so relentless, so aggressive, that historic downside moves are erased within hours and the bull trend simply resumes. Look at today's timeline. At 9:15 a.m., silver was trading at 121. By 10:29 a.m., it was crushed down to 106. By 4 p.m., silver was back up at 117. For 4 years, silver was trapped between $20 and $30, barely moving 50 cents in either direction on most days. Now we're seeing $15 daily swings. The volatility is completely insane, and here's the critical detail most people are missing. Nearly all of the selling in silver this week has occurred during U.S. market hours. The United States sells paper, digital derivatives, leveraged contracts, empty promises. The rest of the world buys physical metal. That's the pattern. That's the signal. When New York opens, paper gets dumped. When Asia wakes up, physical buying comes in and prices recover. This isn't random. The bullion banks that are short hundreds of millions of ounces of silver are becoming increasingly desperate to escape the position they're trapped in. So desperate, in fact, that they've launched 2 separate $15 raid attempts on silver just this week. 2 of them. And what do they have to show for it? Spot silver back above 117. Instead of triggering prolonged follow-through selling like in the past, silver now rebounds almost instantly once the COMEX paper dump ends. Unrelenting physical demand from India and China simply will not allow bullion banks to suppress prices long enough to unwind their deeply underwater short positions. The Shanghai premium pushing past 25 per ounce is screaming monetary regime change from the West to Shanghai. The price gap between Shanghai and LBMA COMEX, growing by $2 to $5 per day, is completely unsustainable. Connect the dots and the picture gets even darker for the paper system. Cracks have already started forming. First, U.S. refineries locked up. Backlogs forming, metals no longer being accepted. Then, by midweek, the retail market began to fracture as reports surfaced that many local coin shops had halted purchases due to capital constraints and slow turnaround times. Then on Thursday afternoon, sources high inside the retail bullion industry reported that a major government mint will be shutting down silver sales within the next 24 hours. First refineries, then coin shops. Now, government mints. The entire system is coming apart, and the real short squeeze hasn't even started yet. Let that sink in. We're not in the squeeze. This is just the opening act. This is the physical market beginning to assert dominance over the paper illusion. Now let's talk about what actually triggered this morning's crash, because there were multiple forces at work. First, excessive leverage. Traders piled into futures contracts with 50x to 100x leverage. When selling began, it triggered a chain reaction of forced liquidations. Small price moves turned into massive sell-offs as margin calls hit and positions were automatically liquidated, vaporizing trillions in paper gains. Second, profit-taking. Gold is up roughly 160% over the last 2 years. Silver is up close to 380%. Those are parabolic moves. After a run like that, people lock in gains. They take profits. That's normal. Third, the broader market sell-off. Microsoft dropped 11% today after disappointing cloud and AI growth numbers. Morgan Stanley removed it from their top picks list, dragging the Nasdaq and S&P 500 lower and triggering a risk-off cascade that hit everything. Fourth, extreme overbought conditions. Gold and silver were pushing into the most overbought territory in their history. Markets always flush out weak hands when conditions get that stretched. That's textbook. And fifth, there was no external catalyst, no policy announcement, no new war, no central bank shock. This was pure technical unwinding and position liquidation. All of these factors are real. Every single one played a role. But here's the mid-video revelation that changes everything. All 5 bearish forces hit at the same time. Leverage unwinding, profit-taking, equity sell-off, overbought flush, and technical capitulation, and silver still turned green on the same day. That tells you everything you need to know about underlying physical demand. The paper market threw everything it had at silver, maximum bearish alignment, and it was fully absorbed and reversed within hours. Gold itself dumped 8.2% in a single hour, erasing $3.1 trillion in market value, then surged back 5.2% and added $1.9 trillion right back. A $40 trillion asset is now trading like a meme coin. That's how fragile the pricing mechanism has become. That's how much leverage exists. That's how disconnected paper markets are from physical reality. And speaking of disconnects, listen to what the major banks are now saying publicly. JP Morgan now sees gold pushing toward $8,000. According to JP Morgan strategist Nikolai Panagurtsoglu, gold could continue climbing as private investors increase portfolio allocations from roughly 3% to 4.6% or even 6%, potentially driving prices to $8,000 to $8,500 per ounce. Gold recently hit $5,600 on safe haven demand, central bank buying, and capital shifting away from long-term bonds. Look at the progression. Goldman Sachs, $5,400. Yesterday, Deutsche Bank, $6,000. Today, JP Morgan, $8,500. Who's bidding higher? Targets keep rising because the fundamentals keep strengthening, and banks are finally admitting what the physical market has been shouting for months. We're in a new regime. The old price anchors no longer exist. Now let's address the bearish case directly, because ignoring risk is irresponsible. We just witnessed extreme volatility, $15 intraday swings that can obliterate leverage positions in minutes. If you're trading on margin, holding paper contracts, or running options and futures with tight stops, this environment is a liquidation engine. Your thesis doesn't matter when the margin call hits. Your long-term conviction doesn't matter when forced selling begins. Over-leverage yourself, and mornings like today will wipe you out before you even see the bounce. JP Morgan themselves warned that while momentum drives prices higher, it also creates more opportunities for violent profit-taking. The higher we go, the more leverage builds. The more leverage builds, the more brutal the deleveraging events become. Gold shows stronger liquidity than silver or Bitcoin, meaning silver could experience even larger percentage swings, both up and down. There's another risk. If equity markets continue falling, if recession fears intensify, forced selling in metals could occur as investors scramble for cash. In panic moments, correlations spike. It happened in 2008, it happened in March 2020, it can happen again. But here's why the bearish case, while real for traders and leveraged players, does not change the structural reality for physical holders. Every single data point reinforces the bull case. Shanghai premium at $25, refineries locked up, coin shops halting purchases, government mints shutting down silver sales. 2 $15 raids this week, both fully absorbed and reversed. The physical market is screaming shortage. The paper market is screaming manipulation. And the physical market is winning. Silver turning green after a 15% crash in the same day is unprecedented. It has never happened before. Ever. In the past, moves like that caused weeks of selling. Now banks can't even suppress price for a single session. Indian demand, Chinese demand, Asian demand, it's relentless. It's overwhelming paper dumps. The Shanghai premium rising $2 to $5 per day cannot continue indefinitely. That gap must close, and it will close one of two ways. Either COMEX prices rise to meet Shanghai, or physical metal stops flowing west entirely, and the COMEX LBMA pricing system loses credibility. We're already seeing early signs of that breakdown. Refineries backing up, coin shops halting purchases, mints suspending sales. The plumbing is seizing. So where does that leave us? 3 key takeaways, then we're done. Number 1, the old playbook is dead. Comics can no longer dump paper and trigger weeks of selling. Silver fell $15 in 30 minutes and turned green the same day. That has never happened before. Physical demand from Asia is now powerful enough to overwhelm any paper manipulation attempt within hours. Number 2, the system is breaking in sequence. First refineries, then local coin shops. Now major government mints shutting down silver sales within 24 hours. This is physical demand overwhelming supply. With the $25 Shanghai premium pulling metal east faster than the west can replace it. The real squeeze hasn't even started yet. Number 3, big banks are revising targets higher in real time. Goldman $5,400, Deutsche $6,000, JP Morgan $8,500. They're acknowledging the regime change. Private investor allocations rising from 3% to 4.6% or 6% represent massive capital flows just beginning. And silver, with its smaller market and industrial deficit, is levered to that move. The unresolved question is this: how long can a $25 Shanghai premium persist before Western pricing loses all credibility? How many more $15 raids can banks attempt before realizing control is gone? And what happens when the physical squeeze in the plumbing finally hits derivatives markets and forces mass short covering? We are watching the transition from paper dominance to physical dominance unfold in real time. The moves will be violent, volatility will be extreme, but the direction is clear. Do your own research, know the risks. If you're trading leverage, this environment will destroy you. If you're building physical with a long-term view and understand the structural shift underway, this may simply be the final shakeout before the real move begins. Invest with logic, not hype. OG out.